Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good afternoon. Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday, the 4th of January, 2018. We're getting on to 4:45 p.m., so these boards are going to erase in about a minute or so. Tomorrow we get all-important jobs data. But all the economic data that's been coming out so far keeps supporting the thought of strong economy both in the U.S., China, Europe. It's just the world is on fire. Good things are happening at the expense of the dollar, which is falling, which is offering a bit of support to the metal markets. But the stock market's the story. Record high close, first time over 25,000, and up and away you go. Energy markets with a bit of a gain, but the moment you get a crack in the weather at all, this natural gas has problems, and even the amount of takedown today at, I think it was 206 billion cubic feet, wasn't the 220 they were looking for in all this terrible weather. So bearish news hit that market one more time. As we take a look at the weekly area chart of closes, pretty hard to argue that the market just isn't up, and away. I mean, all you got to do is buy, close your eyes. And it's so hard to report on it every day because it doesn't back off. It's basically a market that starts, goes, and that's been where it's at. The first 4 days of the year, powerful, and you can see this vertical rise just on a closing basis in the March S&P. Can't get away from that. When we take a look at last Friday, this was the outside day down. You took out that high yesterday. And one of the things that sets up, it's called a bear trap. The reason it's called bear is when you have an outside day down, the thing it shouldn't do is take out the high of that day, at least the way that I teach charting in my course, for a minimum of 2 sessions. If it does, what it sets up is a group, especially if you're coming off sideways action, that gets caught. And as that group gets caught in the chart, the price action representing the group, the market can start, if you will, running against it. And that's exactly what you've had over the past 2 sessions now. When you look and see the swing line, you can see you still have a pattern of a lower low and a higher high. In terms of moving averages, the pullback, all it did is go to what I call the line in the sand. I define the line in the sand, that neutral zone, as the 18-day moving average of closes. And you'll discover if you do your chart work that more times than not, the market's up a lot or down a lot, that number seems to be where the market gravitates to figure out what it's going to do next. In this case, it's well over the 100-day moving average of closes as well. Now, yesterday, not today, the market got to the upper Bollinger Band and stopped there. The other indices didn't. I wrote last night in my nightly report that I think we're owed those other indices going up to those, and if you got the report, you saw that. Well, today you're up and over the upper Bollinger Band. What are the odds of staying over an upper Bollinger Band? 5% of the time. That doesn't mean it can't just fall back under it and still keep this upside bias. It can. But if you keep buying over Bollinger Bands, all I'm saying is it offers, the market in theory, offers better ways to get in. Not saying the direction has to change or any of that. It seems to get ahead of itself, and that's how I'm reading it. In terms of momentum, we now have a market that was overbought, and it's trying again, once again, to embed. Now, embedding means you take a market, and if you're overbought, you convert it to getting much more bullish. It takes at least 3 days of readings over 80 back to back. Day 1, 2, you don't have it. You had the other day, this day, Tuesday, didn't have those numbers. So I just view the market as having hit upside targets in an overbought situation. Momentum is up but overbought, and the bias is up. Got to be a bit careful here. You're walking into a Friday. Will you get some profit taking in front of this fabulous first week of the year? If the NASDAQ up to the upper Bollinger Band, unlike the S&P, plain overbought. Can't even think of embedding. The pattern, lower low, higher high, did not have that outside day, or did it? Now let's take a look. If you take a look at this last Thursday, and here's the Friday action, you didn't have an outside day. This just came back with the other indices on its own. When we take a look at the Dow, it did it. This was the outside day down on Friday. If you take that day's high out within 2 sessions, didn't do it yesterday, if you do it now, that was Tuesday rather, if you do it, and you did do it on Wednesday, my target is the upper Bollinger Band. That's where you went to today. This market is overbought as well, not ready to embed either. The Russell, this one's a little harder to do. It had the outside day down, but if you look at how narrow these Bollinger Bands are, even if you get back over it, and you did that yesterday by 60 points, you're owed the upper Bollinger Band. You went to it today and you stopped literally at that number and barely hung on the rest of the day. You gave up about 8 points from there, and you're overbought. So what I'm saying is the upside targets off of the reversal day have been hit. The trend, well, you don't need me to tell you the trend has been up. You don't need me to tell you it's been a bull market. But at some point, profit taking will kick in. At some point, this new allocation of money will rotate, and you get these reasons for back and fill trading. But I don't worry about that. Not interested in a break or no break. I'm more interested in sideways action that offers opportunity on breakouts, upside, downside. That's what I'm looking at. In the VIX, you went from the upper Bollinger Band to the lower Bollinger Band and held. I think I've been on record with you, if you're regular viewers, telling you it is going to be so difficult to take this market down another 10%. Why? It's not the same as rallying back up from 891 to 10. To get it to from 891, let's say, to 8, you got to almost make new lows for the whole move. And in the process, you got to get under that lower Bollinger Band. Very, very difficult. That does not mean it's a buy. I think this is where the pros are covering shorts. Then in between the 18-day average and the upper Bollinger Band, they seem to be selling it again. In TLT, this is an interesting chart. If we take a look at yesterday's high, that was 126.20. You did not take that out today. But you have one of these chart setups that it takes very little to not only get over that, but this 18-day average of closes is probably going to drop a couple of cents, maybe 1 to 3 cents tomorrow. And if it does, if you get over that number, all of a sudden you could have a pattern of higher lows and higher highs. Therefore, what the bears have to do if they want this market to be bearish is they have to defend that and not let it happen. Otherwise, that pattern kicks in. If we look at the bond market, it ties in with the TLT, except we already have the pattern of higher lows. You also have lower highs. So this market needs to pick up, get up over this resistance area if it's going to be bullish of 152.25 to 152.16. Is it a buy here? No, because it's under the 18-day average. Is it a sale? No, because you've got the swing line up. And you've got that funny pattern of lower highs, higher lows. So need more things to do. Where you've had a more pronounced bearishness has been as you get closer and closer to the front of the curve yield, where the Fed, their threats of raising interest rates 2 to 4 times next year. Well, I said 4 because some people think that's it. The Fed said 3, but we'll see what happens. But you got lower highs, lower lows. Market, if you take a look, you're oversold. Any reading under 30, in my opinion, leads you into an oversold condition. Trend down, objective, if it can extend, might be the lower Bollinger Band. In the dollar index, big failure today. You have an embedded reading. You have a market that went through yesterday's highs, came crashing down, right back down to the lower Bollinger Band, and in the process, an outside day. So no different than in the stock indices, you don't want to see this high taken out in the next 2 sessions. If it is, I'll call it a bear trap, and I wouldn't be surprised if the market tried to get back towards the 18-day average of closes. Converse, the other side of the argument. Failure, market got a bearish crossover. The 18-day average went under the 100. You have an embedded reading. All systems still go to the downside. In the eurocurrency, let me get on the other side of the mirror. Which one do I want? Because that's what it is. Higher lows, higher highs, up to the upper Bollinger Band, slightly over it, embedded reading. Bullish crossover took place right here, and away you're going now. You guys still haven't made the higher high, I think. Let's see, or you did. Today you did. You got to 121.40 and a half, taking out that high, which is often what happens. You go for another high on bullish crossovers or a new low of the current move on bearish crossovers, and that's what you've got here for the time being with the embedded reading. This is a market that's had a nice seasonal play, an extremely powerful one that often runs out of momentum in terms of the seasonality only this week. That does not mean it has to stop going up. China came out today from a fundamental point of view and said that they expect their economy to grow 6.5% for the 2018 timeframe. That's still pretty darn good. It's the same number as last year. Obviously, this market liked that, up and away it went. And they're repegging the yuan. They did that today. It was interesting how they ended up doing it. I think it was the strongest number that they've done in quite a while. When you look at the yen, back to the 18-day average of closes, that line in the sand. You also have this support that's going sideways now in the market. I shouldn't say support, the Bollinger Bands. From that often comes a trend. Now, the seasonals turn down in this currency in another week or so. I'm just giving you what the seasonality is of the market. It doesn't mean it has to work. I have seen bear seasonals and you get into a bull trend, they run right over them. But we'll see what happens. In the meantime, the bulls have control. They're supporting the market at 8,900. I think they throw in the towel if you take out that swing line low of 88.62. And if you did that, the momentum would turn down. Right now, momentum is pretty flat in this market. In the Bitcoin, again, think of the neutrals number. And this is the 15-minute average. Got it? So I'm taking 18 bars of the 15-minute average of the close of that 15 minutes and putting it on here. Tell me that you're not finding support when you've hit those Bollinger Bands and you're pulling back to it. Same concept. That's what I'm talking about. Now, when we take a look at the March Brent versus the WTI, you're in a corrective phase. So the Brent is starting to lose to the WTI. Part of it is that the 40s pipeline in the UK should be, I keep looking for the news. I keep reading trade sources that say it's fully operational. I'd like to see the company say that it's fully operational, but that means oil's flowing. It means the refineries are up. The 80 oil rigs out there, they're going to be pumping in oil, and you're seeing that that's pushed pressure back on the market. Plus, Libya's got its pipeline up, and some problems in Nigeria. They don't seem to be getting real traction, although there's always problems in Nigeria. In the February Brent crude, riding the upper Bollinger Band with an embedded reading, still quite bullish. WTI, higher lows, higher highs, riding it. Nothing has changed here. You're now up to $62. I can't imagine that U.S. shale producers aren't using these funds to go in and lock in hedges in these markets in some manner so that they know they can turn on their wells, cut them back, whatever they want, but they're guaranteeing themselves a profit. And that's what I think is going to go on in this market. In the gasoline, back up into this resistance area, we've come back to the point where the market yesterday, if we take a look, you had lost the embedded reading on Tuesday, and when I say lost, both numbers are under 80, still there. Today they get back over, they're just plain overbought. I view this whole area as what we'll call a funky area because you got lower highs, lower lows. Today you stick up to 180, 111, you take out that high, so you're still going to have, if you look at it, a lower low and a higher high. There's no trend here and you're overbought. Let's assume it moves forward. Look for the upper Bollinger Band to be the resistance. Let's assume the market decides to break back. Support's back at the 18-day average of closes. Now in the nat gas, I would call this a pretty miserable failure on the rally between the upper Bollinger Band and an attempt to get to the 100-day average. Now momentum is gradually turning back down. You established a pattern of lower highs, lower lows. That is not bearish per se. Yes, the swing line trend is down, but when you're over the 18-day average, it means the bias is up, the two fight each other, you have nothing, and you certainly have lost the upside momentum. If you were to take out today's high, be it Friday or Monday, then the target would be the 100-day average. If you don't, the odds favor you're going back to the 18-day average to regroup, if you will. I don't see a trend on the market. So you've got your clean boards behind me, and now let's talk. For those of you that have never seen it, we have 2 volumes of guides to technical indicators. Let me turn this off so that we're all okay. I don't want that on. There we go. Give me 1 minute here. So to make a long story short for it, we've put together guides, technical guides 1 and 2, and on those guides, they will show you what I'm working with here. They will explain it in a way that is easy to understand. You print it out yourself. We're going to send it to you as a PDF, and you can take them, you can read them, see what it's about. But everything you see me talking about is in some manner covered here. And then if you're a Fibonacci, a Gann follower, Elliott Wave follower, the other guide covers all that. So be it the oscillators, the moving averages, they're here. Just give us a call at this number. Go to our website. You'll see our carousel of free offers. You can click right up here if you're watching me on YouTube, or underneath us it says, click here for Ira's free info. Do so. We'll put it in your hands. I'm Ira Epstein. Have a great day.